Good morning. On today's Money Not Math conversation, we're going to be talking about life insurance. Oof. Are you like many people who are like, life insurance? How boring or how sad or how traumatic is that? All right. Well, normally I hate talking about products because it's not what you do, it's why you do it. In the words of Simon Sinek, that's really important in this world. And why I do what I do is, the most important thing, and that's to provide for my family while being there for them. And my goal is to help others achieve that same um, life success where they are able to enjoy their lives and not without stressing about their money. But today I'm making an exception because I found an article that I think is pretty interesting in outlining the offensive parts of life insurance. So most people, when they think life insurance, they're thinking the money they leave those when they die, right? Protection for those you love. But life insurance, when built correctly, keep in mind there's many different types of life insurance out there, just like there's many types of automobiles. An F-350 is great for towing capacity, but probably doesn't have the best gas mileage. A Toyota Prius has great gas mileage, but probably doesn't have very good towing capacity, right? So there's all these different kinds out there, and it's such a diluted world that it's often confusing on what types make the most sense for the right situations. And even more so, they get unfairly and incorrectly compared to each other and outside assets like Roth IRAs and stock market, mutual funds, things like that. So we have to keep in mind that no asset or tool or product that we use is good or bad until compared to its alternative. And not a single tool is good for all situations or bad for all situations. So it's extremely important to understand why we do what we do. And today we're just going to talk a little bit about what one of those tools can be, because I think it's interesting to look at things from a different light. So the article we're reviewing is Cash Value Life Insurance Provides a Safe Harbor in Today's Economic Storm. Written by Mark Schechter, I believe is the name, on Forbes.com. I'll be jumping in and out of reading the article and adding my own insight here. But in light of recent market challenges that have impacted the diversified investment portfolios we manage for our clients, many have asked how the cash values in their investment-oriented life insurance policies are weathering the storm. Whole life insurance, universal life insurance, and index universal life insurance have traditionally maintained their values through tough economic times because they are designed with that very goal in mind. And oftentimes you can build them to have guarantees that they will not lose value when the market goes down. So when the market goes down 30%, if built correctly or in certain ways, there are life insurance cash value contracts that are guarantee they won't go down. So today is no different. When equity markets are up and the economy is running smoothly, it's sometimes easy to overlook the value of the downside protection you get from using life insurance as an investment. Life insurance will never be your best performing asset when things are good. It's not supposed to be. But in times of turbulence, it can provide a stabilizing influence on the overall portfolio and the potential source of cash that can be drawn upon without incurring market losses. When structured and funded properly, these policies are designed to provide moderate, steady growth when extremely low risk of loss. So here's where I come back to nothing is good or bad without comparing to its alternative. So when times are good, right, when it's a bull market, so the market's going up, 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 like it pretty much did from 2008 to 2019. If you compare rate of return on an average standpoint, the stock market is going to beat life insurance cash value, right? So that's where it gets its bad name because people like to compare apples to oranges. But if you switch the comparison, you said, okay, life insurance cash value to a savings account, now the life insurance cash value wins. So you have to decide for yourself from an aggression standpoint what's more important to you. And the second part of that, for anyone who really has ever talked to me or worked with me, knows you have to also ask yourself what's more important, how fast your money grows or how much it pays you in retirement. And there again, it might make sense to compare your alternatives because the stock market may not be your best bet. The other side of that is the risk with the potential growth, but also the risk of the investments you make. When it comes to investing in, let's say, a Roth IRA mutual fund versus whole life insurance cash value, the Roth IRA mutual fund may go up 30% a year, but it also may go down 30% a year. Where the cash value, depending on how it's built, but if built with guarantees included, it might only go up 5% on a great year, but it won't ever go down below, let's say, 1% on a bad year. Some of them are built with guarantees to not go down, but it all depends on how yours is built and who built it. from which company. All right, so again, just keep in mind, no tool is good or bad until compared to its alternative, and no tool is the correct tool for all situations or the wrong tool for all situations. So continuing on, it's important to keep in mind a few key differences between insurance companies and other corporations, including banks. To understand why insurance companies are generally more financially stable than banks, particularly during times of market volatility. Investment risk. Insurance companies invest the premiums they collect from policyholders in long-term assets such as bonds to ensure they can put out insurance claims as they occur over time. Most life insurance company assets are required to be made in high-quality investments, with approximately 85% invested in investment-grade corporate bonds and U.S. Treasuries, which traditionally perform better than the stocks when corporate finances weaken. This means that insurance company investments are generally less risky when compared to the investments made by banks and their affiliates, like Wall Street or the stock market, or those that make up the stock market, whose structures and regulations do not limit their investment of lender deposits in a way that corresponds to their anticipated liabilities. Insurance carriers are not allowed to use leverage. Unlike banks, investment funds, and operating companies, government regulations prohibit insurance companies from using leverage to enhance their performance. This prevents any losses from being compounded during market downturns. So if you want to know more about leverage, we'll have to have a deeper discussion. But basically the way banks leverage liabilities is they like to use the money you deposit to lend out and leverage to other people to make more money off of your money without affecting their money. So it's a really confusing way of saying it. If you want a more in-depth explanation of how banks make money, let me know. The point is, banks use leverage just like a lot of wealthy people and wealth creators leverage debt to make money. Insurance companies don't, because they have to be consistent, safe, and ability to pay out people's death benefit when they pass away and provide cash value when people ask for it. Insurance carriers are heavily regulated. Insurance companies can become insolvent. However, these scenarios are historically rare. This is because the states that regulate insurance companies take poor performing insurance companies into receivership if and when their assets drop to approximately 90% of their liabilities. At that point, they have approximately 90 cents on the dollar to pay off their liabilities. So let's put this in perspective. What they're saying is if an insurance company has $100 billion of liabilities, also known as, or potentially the death benefits they could pay out if every one of their policyholders passed away the same day, if they have less than $90 billion in cash available to pay out those death benefits, the state will claim them unhealthy and take them into receivership. In contrast, a bank, and this depends on the size of the bank, the federal, the local, things like that, so these could change a little bit, and feel free to correct me if I'm off a little bit here, but typically banks only need to have like 10% of their liabilities on hand. So if they have $100 billion liabilities, they only need $10 billion in cash. Imagine the difference there in risk averse and consistency and safety and compliance and things like that. It's amazing how different that is. In contrast, most financially challenged corporations are left with an extraordinarily small amount of assets to value when they go bankrupt, and creditors are typically fighting for a much smaller 10 cents or 20 cents on the dollar. My example, 10% of 100 billion or whatever the value of the company is or the liabilities are. Insurance companies have failed in the past, but due to the state oversight and intervention, the companies in the industry ensure that payment of guaranteed obligations of the company is made to policyholders. In fact, most states, and I shouldn't say most, maybe I haven't counted them, but many states, I believe most, have guarantees in place so that if your company goes insolvent and someone else doesn't buy the company, so your policy is just left with no owner, the state will guarantee up to like $250,000 of death benefit. So in challenging economic times, or maybe it's 500. I'm going to correct that once I get off this video, and I'll include it in my comments. In challenging economic times like these, policyholders are appreciative of the slow and steady 4 to 6% tax-free compounded long-term returns that properly structured insurance designs offer. I'm going to say that again. In challenging economic times like these, policyholders are appreciative of the slow and steady 4 to 6% tax-free compounded long-term returns that properly structured insurance designs offer. There are many inappropriately designed contracts. Generally, the dollars that have been allocated to these products are longer term dollars that would otherwise have been invested in stocks or bonds. Some clients own these contracts inside of their estate in cases where they intend to access tax-free dollars during their lifetime, while to use for unexpected life events or wealth creation opportunities, while others have invested dollars that they had already transferred to an irrevocable trust for the benefit of their children or grandchildren, where the death benefit component of these policies will ultimately enhance the amount of wealth that passes to the next generation. Keep in mind, life insurance death benefits are, I believe, almost always tax-free, which is one of the few ways wealthy people are able to pass wealth from generation to generation to generation to generation without having Uncle Sam reach into their pockets multiple times for taxes. In either case, it is in an environment like we have today that these policies are most appreciated because their value is unlikely to be impacted in any significant way by the volatility that is currently battering the rest of the economy. While these are turbulent times, policyholders can rest assured that their assets at these life insurance companies are safe in an industry that has secured such assets for hundreds of years. We anticipate nothing different in the challenges to come over the next 100 years. So basically, like I said, why we do things is more important than what we do. So coming back to planning, some reasons why you may consider utilizing life insurance from a protection standpoint is to protect the ones you love. From a business standpoint, buy-sell agreements, key person insurance, things like that, really to protect those you love, protect your business, and protections often comes up with life insurance. That's the defensive side. Also, on the offensive side, reasons you may consider a life insurance when built appropriately and correctly are if you prefer consistent, safe growth over playing the stock market, which to some people feels like going to the casino every day. If you prefer tax advantage growth and you don't have other options available or just don't like your other options available. If you're looking for ways to grow your wealth while maintaining access to it, there's many different things to think about, but at the end of the day, it's not what we do that's really important, but why we do it. So I strongly encourage you, if you have questions about this topic specifically, or just about planning as a whole, reach out to someone you trust. And if you don't have that person, of course, I'm always available to help, and I love having conversations. In all situations, if I'm not the expert and I don't know how to answer your questions, I promise to find someone who does. So thanks again for your time today. I hope today's conversation brought you value. Please let me know what questions you have by leaving a comment, clicking like or sharing with a friend. I really, really do appreciate it, and I hope you have a great rest of your day. Thanks, and bye.